Welcome back to Alpha Recap, your laid-back, get-it-done look at what moved markets today. As always, if you have questions, you can reach us at stockalpha.ai. I've got Ryan with me, and we're breaking down a risk-on rally that was, pretty concentrated. Ryan, good to have you.
Great to be here. Thanks for having me.
So, what really stands out here is the gap between big tech and the rest of the market.
Totally. Markets closed up overall. The tech-heavy index finished the day up about 1.5%, while the broad S&P tracking ETF was up about 0.5%. Small caps lagged, down roughly 1/3%. Big divergence.
That spread, big tech leading, small caps trailing, felt like the headline. What drove that, in plain terms?
Two big forces. One was renewed AI optimism, concentrating capital in a handful of mega-cap names. The other was huge dollar flow dynamics from asset managers that basically pushed risk onto liquid large-cap shares.
Right. And the other thing is, BlackRock had a monster day, yes?
Exactly. BlackRock reported its best ever flows and a big profit beat. Assets are now about $15 trillion. That kind of inflow signals institutional willingness to allocate risk, and that tends to lift the biggest, most liquid stocks and ETFs.
Honestly, I was a bit surprised by this one.
Yeah, it's the scale that matters. When asset managers move this much money, it changes market structure. Analysts note those flows can lower risk premia and tighten lending spreads over time, which feeds back into equities. And when you connect that to upbeat corporate headlines, record revenue at a big bank, some beats in staples, and continued AI chatter, it's a simple recipe for concentrated outperformance in the names tied to that theme.
Walk me through the sector winners and losers. What led and what lagged?
Information technology and communication services led. Software, semiconductors, and cloud providers outperformed thanks to the AI narrative. Financials also did well after a strong quarter from Morgan Stanley and the spillover from asset manager results. Real estate and materials moved constructively, and utilities showed selective strength in renewable adjacent areas. Energy was mixed, and pockets like cannabis and small-cap discretionary lagged.
So it wasn't just tech. Financials got a lift too.
Right. Morgan Stanley printed record revenue and profit, and that reassured investors about fee-based businesses. Combined with BlackRock's flows, you had a clear positive read on asset management and related financial names.
Got it. Any standout company moves we should call out?
Big movers included BlackRock for obvious reasons, Morgan Stanley on its results, and Johnson & Johnson had a quarter that beat expectations, which helped defensive sectors. The usual AI leaders, NVIDIA, Microsoft, Alphabet, and Meta Platforms, were big contributors to the tech outperformance. IBM had a reversal on mixed execution remarks, and Remax saw volatility after some real estate deal updates.
Wait, really?
Yeah. IBM's longer-term AI positioning still looks interesting, but analysts flagged near-term execution concerns, so the stock swung on that nuance.
Short reactions.
Right.
Breadth seemed a bit thin, though. Can you explain what that means for regular listeners?
Sure. Breadth is about how many stocks are advancing versus declining. Today, headline indexes ticked higher, but most of the gains were concentrated in mega-cap names. Small and mid-caps lagged, so fewer stocks were actually participating. Historically, concentrated rallies can run for a while, but they also set up sharper pullbacks if leadership stumbles.
I mean, when you step back and look at this, that makes sense. Momentum can be powerful until it's not.
Exactly. Options activity also showed increased demand for call exposure in the big names, which is consistent with a momentum-driven bid. But that also increases the potential for quick reversals if sentiment shifts.
Let's talk macro briefly. Did any economic data change the picture today?
There were no shock macro prints. The market's reaction implied continued belief in Fed patience. Traders seem to operate on a rates-on-hold assumption. But the Fed remains data-dependent. Upcoming CPI, PCE, and employment reports remain the key inputs that could reprice expectations quickly.
So the tape was more about earnings and flows than the Fed, for now.
Right. And analysts note that sustained flows into risk assets can indirectly affect financial conditions. If asset manager inflows keep compressing risk premia, that alters the backdrop for growth stocks. But if those flows slow, the narrowness of the rally could become a vulnerability.
Okay, for listeners who like a checklist, what should they watch next session?
Watch 4 things: continued earnings and guidance from big financials and mega caps, inflation prints like CPI and PCE, weekly jobless claims and Fed commentary, and flow dynamics into ETFs and active strategies. Also keep an eye on semiconductors and cloud software. If leadership rotates out, breadth could finally improve as capital moves into small caps and cyclicals.
Right.
And remember, analysts say momentum still suggested upside existed, but concentration argued for caution on conviction sizing and risk management. That's just market structure talking, not investment advice.
Short reactions.
Yeah, that tracks.
Quick historical note. How does today compare to prior AI-led stretches?
It felt familiar. Earlier, AI-led rallies also skewed toward a few leaders and masked weak breadth. If inflows persist and earnings stay strong, the market can keep making headline gains. But if either element falters, a reversal in leadership could produce broader weakness. Analysts highlight the structural tailwinds, durable fee income for asset managers, and accelerating enterprise AI spending. But they also point out valuation dispersion and the benefits of diversification. Quick bottom line. July 15th session was risk on, but narrow. The tech-heavy index was up about 1.5%, the broad market was up about 0.5%, and small caps lagged, down about 1/3%. AI optimism and blockbuster asset manager headlines drove large cap concentration. For now, flows and earnings look like the main fuel, but data-sensitive Fed risks and narrow breadth are the watch points.
Good summary. Any final takeaways for listeners who want to put this into practice without getting prescriptive?
Sure. Keep an eye on leadership concentration, monitor flow reports and big figure earnings, and follow the key inflation and labor prints. Analysts note that momentum is real, but so is the risk of sudden reversals when participation narrows. This is informational market analysis, not personalized advice.
Perfect. If you enjoyed this, remember, if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening.
Thanks. Talk soon.
Take care.